Good afternoon and happy Thursday, everyone. It is Scott Wohlers with River Place Capital. It is Thursday, October the 20th, and just wanted to touch a brief moment on what markets did last week. The S&P 500 did end a winning streak and was down 1.55% on the week. The mid-cap index, as measured by the S&P 400, was off as well, down a little less, down 96 basis points or 0.96%. And the small caps, as measured by the S&P 600, were the outperformer, only down 0.2% or 20 basis points for the week. And so one of the big takeaways is we had some very nice market moves Monday and Tuesday this week, 2% up on Monday, another percent on Tuesday. And this is really off of the backs of corporate earnings. And we're getting some earnings from the banks. They're typically the first to report, as well as some consumer staple companies that have reported as well. And what we are taking away so far from these earnings reports is A, they're better than expected, meeting analyst expectations and above them. Margins are maintaining where they are. These companies, especially the consumer product companies, are able to pass on higher prices to maintain their margins. So volumes are down, but earnings are up, and that's due to higher prices on some of these consumer product companies. And for the banks, rising interest rates are very much a tailwind and very much a catalyst to provide windfall earnings for banks. Because remember, they charge more for loaning out money, and they are lagging when it comes to paying that out to savers and deposits. So the spreads are at highs that we haven't seen since before the financial crisis with some of these financial institutions, and they're able to make plenty of capital. Now they're warning about the potential of what might happen in 2023. Everyone's talking about a recession in 2023, that we're going to be in one. It's going to be a deep recession. Well, there's a chance also that we don't hit one, or if we do hit one, that's what's been priced into the equity markets. And so what we're seeing from these corporate earnings, and what we hope to continue to see, is that things are still in the economy very strong, and that we can maintain that, and maintain that with higher interest rates. Remember, markets have done well historically with higher interest rates than what we've seen today, and markets have been able to produce capital. But what you're seeing is a reversal in the market of what's really been working for the last 10 to 12 years, is companies that were selling at price to sales multiples that had no earnings, that were beneficiaries of zero interest rate policy, or free and cheap money, as we would say. And so they've been benefiting from that, and they use zero interest rates or very low interest rates in their forecast models as they were forecasting out for the next 10 years or so, when they were doing their pro formas and things like that and their projections. And the problem is, well, we're not there anymore. We're not in a free money environment, and investors have realized that these corporations that have not produced any type of earnings need to start showing how they can provide earnings and returning capital back to shareholders, because there's now competition in the marketplace. You can get attractive yield and fixed income. You can get things like that that haven't been available for the last several years, maybe the last decade plus. So you can get some real returns now and some fixed income. So for you to look at the landscape as an investor, this is a great opportunity, as we discussed last week, to get into these equity markets. But you've got to be very selective about what it is that you are going to invest in and how it's positioned. And we are very excited at River Place that we're returning back to what we call GARP, growth at a reasonable price investing, where it matters what products you have, your moat in your environment, and your ability to maintain margins and return capital to shareholders. And that's what's driving markets higher. And that's why you've seen the value index well outperform the growth index year to date. And we believe that it will continue to do the same, as investors are looking to find those companies that have the fortress balance sheets, that know how to manage capital and can handle the higher interest rate environment, or even a consumer slowdown. So as always, if you have questions about how to navigate this time, just give us a call. We're easy to talk to. We'd love to talk to you about it. You can reach us at 904-346-3777. 3460, or as always, visit us online at www.riverplacecapital.com. I hope everyone has a wonderful rest of your week. Thanks so much.